The central question: a new Cold War for India. India, at a significant historical crossroads, navigating a complex global landscape. The nation is driven by a powerful ambition for rapid economic growth and development. Simultaneously, it holds a deep-seated desire to maintain its freedom to choose its international partners and to forge its own foreign policy. This dual objective creates a profound and demanding test for its leadership. The core of this challenge lies in balancing strategic independence against the considerable pressures exerted by major global powers, most notably the United States. Is India inadvertently drifting into a new form of Cold War with the United States? And more practically, how do sanctions influence financial markets and investment decisions? How does strategic autonomy influence investment decisions? It will use established facts and real-world examples. The analysis will demonstrate the intricate links between India's major defense acquisitions and its overarching political strategy. Furthermore, it will illuminate the mechanisms through which international sanctions can disrupt financial stability and economic progress. The ultimate goal is to provide a clear framework for investors, highlighting the key indicators and risk factors they must monitor. This examination will avoid speculation, focusing instead on tangible connections between statecraft and market performance. The central thesis: while this is not a full-blown Cold War, the friction is real and carries significant financial consequences. Defense choices are no longer merely technical, they are potent political statements. For India, purchasing a Russian missile system like the S-400 Triumph is a declaration of strategic autonomy. For the United States, such a purchase can trigger punitive measures like CAATSA. This dynamic introduces a new layer of risk into the Indian market, affecting currency stability and the stock performance of defense-related companies. For investors, understanding this dynamic is not an academic exercise, but a practical necessity. The potential for sanctions, diplomatic tensions, and supply chain disruptions can directly impact portfolio returns. Therefore, we will methodically break down the pathways through which these geopolitical risks transmit into the market. We will explore the potential impact on stocks, on bonds, and on the Indian rupee. The doctrine of strategic autonomy. The concept of strategic autonomy is the foundational principle guiding India's contemporary foreign and defense policy. In simplest terms, it reserves the right to make sovereign decisions, particularly in security and alliances, without being beholden to any single power. It is a deliberate rejection of formal bloc alignment, allowing engagement with multiple partners based on national interests. For India, this is a modern iteration of a historical stance. It allows military modernization, economic partnerships, and technological progress from many sources, preserving freedom of action on the world stage. While the global context has changed since the fall of the Berlin Wall, the core logic continues as strategic autonomy in a multipolar world. It can cooperate with the United States on maritime security through frameworks like the Quad, while maintaining robust defense and energy ties with Russia. It can purchase advanced weaponry from Israel and from France, while engaging in significant trade with China. This multi-directional engagement manages a complex environment. It limits overdependence on any one country, enhancing resilience against external shocks. For New Delhi, it's the logical path for a nation of India's scale and geography, addressing security concerns from a long contested border with China and persistent cross-border terrorism. By diversifying partners, India accesses technology, intelligence, and hardware to secure its interests. This isn't about being equidistant, but about issue-based coalitions serving specific goals, a necessary balancing act. India's rationale is pragmatic. Real threats drive independent choices. A contentious border with an assertive China requires constant readiness. Persistent risks from state-sponsored terrorism add to the burden. Hence, freedom to procure the most effective systems globally, regardless of origin. The S-400 Triumph decision reflects this logic. Vital airspace defense in a difficult environment. Simultaneously, defense ties with the United States have deepened, acquiring P-8I maritime patrol aircraft, C-17 transport planes, and AH-64 Apache attack helicopters, alongside Israeli radar and French Rafales to maximize capability, not signal block allegiance. Understanding sanctions. The CAATSA framework. Sanctions are powerful foreign policy instruments, used to influence behavior without military force. Penalties designed to deter or punish. Blocking trade activities, freezing assets, restricting individuals, companies or agencies barred from business in the sanctioning jurisdiction. In a dollar-centric system, access to the US dollar is critical. Countering America's adversaries through Sanctions Act, CAATSA, enacted in 2017, broad mandate. Section 231 targets transactions with Russia's defense and intelligence sectors, threatening secondary sanctions on third-party buyers, isolating targets from the dollar system with far-reaching market impact. CAATSA intersects India's procurement policy, creating a strategic dilemma. When India finalized the roughly $5.4 S-400 deal with Russia, it moved squarely into CAATSA's scope. Washington issued clear, repeated warnings. Sanctions could be triggered. The message was unequivocal. Choosing high-end Russian hardware could carry economic and diplomatic costs. India asserted strategic autonomy publicly and privately, framing the S-400 as a technical necessity for credible border threats. India's defense ties with Russia long predate CAATSA, and procurement should not be bound by another nation's domestic law. CAATSA allows a presidential waiver, but it's discretionary, political, and uncertain, shaping market risk. Ultimately, India was not sanctioned, yet the threat itself influenced sentiment and capital allocation. Major systems are more than tools of war. They are symbols of alignment and integration. The S-400 is a premier Russian long-range SAM, renowned for detection, tracking, and engagement of advanced threats, including stealth aircraft and ballistic missiles. Choosing the S-400 shapes security architecture and signals enduring ties with Moscow. The F-35 is a fifth-generation stealth multi-role fighter, centerpiece of US and Allied air power. Operated by NATO allies, Australia, Japan, South Korea, with deep integration to US-led command, control, and intelligence networks. Buying the F-35 means joining a long-term strategic and technological ecosystem. Operating S-400 near F-35 raises US security concerns. Radar data could compromise stealth characteristics. Capturing sensitive signatures risks eroding the aircraft's edge. Precedent. Turkey's S-400 purchase led to removal from the F-35 program. India defies the binary, acquiring Russian S-400 while buying billions in US and allied systems. Interoperable on some fronts, independent on others. A complex strategy for a multipolar era. Geopolitics is a powerful, often underestimated driver of market behavior. Markets are forward-looking and crave predictability. Tensions inject uncertainty. Defense frictions, sanction threats, and rhetoric shift asset prices. In an integrated India, transmission pathways are numerous and potent. Trade disruption, supply vulnerabilities, and capital flow shifts dominate. Sanctions can directly impede dollar transactions through the US system. Trade finance stalls, payments fail, FX debt servicing strains. Economy-wide costs rise, credit tightens, liquidity risk increases. Defense and industry rely on imported components and subsystems. Sanctions on a key supplier can delay and inflate costs. Beyond defense, manufacturing and tech also face disruption. Geopolitical escalations spur outflows, depress the rupee, and pressure inflation, driving tighter monetary policy, slower growth, and lower equity and bond valuations. To decide well, map the channels beyond headlines. Past episodes provide a template. Volatility rises, India VIX spikes, equity benchmarks fall, Nifty and Sensex drop, rupee weakens, government bond yields rise, Dalal Street reacts. Exposure is uneven across sectors, Firms tied to sanctioned suppliers can underperform, while localized supply chains may benefit. Banks with USD borrowing and trade finance face liquidity risk. Import-dependent firms are vulnerable under rupee depreciation. FII outflows rise, INR falls, cyclicals and leveraged credits underperform. Track indices, FX forwards, India CDS, global order books, and official statements, especially CATSA headlines and procurement choices. In uncertainty, static strategies fail. Plan scenarios. Scenario 1. Limited diplomatic friction. India continues mixed procurement. US concerns but wavers on key deals like the S-400. Markets dip briefly, then recover. Maintain diversification. Use dips as opportunities. Scenario 2. Targeted sanctions on specific entities and officials, some banks restricted. Defense deliveries slip. Sustained market jitters, slower foreign inflows, moderate rupee weakness. Reduce links to sanctioned chains. Raise cash and high-quality short-term bonds. Consider currency hedges. Scenario 3. Broad sanctions and deep strategic strain. Dollar access curtailed. Sharp market drop. Significant rupee depreciation. Inflation rises. RBI tightens. Growth slows. Shift decisively to gold. High-grade international sovereign debt. And select USD earners. Continuously. Map portfolio dependencies. Maintain liquidity. Favor strong balance sheets and diversified supply chains. And monitor New Delhi-Washington policy cues. India is not in a traditional Cold War with the United States. The relationship is too deep and multifaceted for simplistic labels. Yet bloc-like pressures return and force choices. India will select partners and hardware by national need, including the S-400, even if friction with Washington follows. CATSA is a real financial risk channel to trade, finance, and the rupee that investors must price. For the affluent Indian investor, the path must be pragmatic and data-first. Treat volatility as baseline, not exception, and execute a multi-pronged approach. Diversify, hedge currency, hold cash, watch policy. Protect portfolios against currency risk. Favor quality, strong balance sheets, diversified supply chains, low foreign debt. Information is a strategic asset. Rhetoric and policy announcements lead markets. Liquidity creates optionality to buy when others panic.